Nobody told you that the person selling you insurance might be the reason you're overpaying by hundreds of dollars every single year. Let that sink in for a second, because the difference between who you buy from and what you actually pay is a gap that the industry has been quietly hoping you'd never notice. Here's the dirty little secret baked into the system. Not every insurance salesperson can sell you every product, and that structural limitation has a very real cost that lands directly in your wallet. Think of it like going to a restaurant, where the waiter can only recommend dishes from one kitchen. You might eat fine, but you'll never know what the place next door was serving. Captive agents work exclusively for one carrier, your State Farms, your Allstates, your Farmers, and while they know their product cold, they simply cannot shop around on your behalf. It's not that they're dishonest, it's that the architecture of their job is built around loyalty to one brand, not loyalty to your budget. Independent brokers, on the other hand, can access dozens of carriers at once, essentially turning your application into a competitive auction where insurers bid for your business. Back in 2008, and again during the pandemic era rate spikes, consumers who switched to independent brokers saved an average of $400 to $900 annually on auto and home bundles alone, according to industry comparison data. But here's where the irony gets delicious. Online marketplaces promise to democratize all of this, giving you broker-like access with the convenience of a 2-minute form. What they often deliver instead is a lead generation machine that sells your information to 6 carriers simultaneously, turning your inbox into a war zone before you've even had your morning coffee. The psychological trap most people fall into is confusing familiarity with value. You've seen the gecko, you've heard the jingle, and somewhere in your brain, that repetition has quietly become trust. Behavioral economists call this the mere exposure effect. And insurance companies have spent billions of dollars engineering exactly that response in you. Historical patterns are brutally clear here. Every decade or so, a new distribution channel emerges, promising to cut out the middleman, rates dip briefly, and then the market recalibrates as acquisition costs get baked back into premiums. We saw it with direct mail, we saw it with 1-800 numbers, and we're watching the same cycle play out right now with app-based carriers who are quietly raising rates after their initial growth phase. The misconception worth destroying right now is that online always means cheaper in reality. Direct-to-consumer carriers skip the agent commission, but often compensate with higher loss ratios and less personalized underwriting, which means you might be underinsured without even realizing it. Coverage gaps are invisible until they're catastrophically visible. And that's a terrible moment to discover your policy was built for speed rather than fit. The practical lesson history keeps teaching is this: use the online marketplace to benchmark your current rate. Then take that number to an independent broker and let them beat it. That 2-step process costs you maybe 45 minutes and historically produces better coverage at lower premiums more often than either channel does alone. Discipline in insurance shopping means reviewing your coverage every 12 to 18 months, resisting the inertia of auto renewal, and treating your policy like an investment allocation rather than a utility bill you ignore. The people who consistently win financially in this space aren't the ones with the best timing, they're the ones with the best process. Running the same comparison ritual year after year without emotion, there's a beautiful absurdity in the fact that we will spend 3 hours researching a $200 gadget on the internet, but auto-renew a $2,000 annual insurance policy without reading a single line. That gap in attention is exactly where the industry parks its profit margin, and recognizing it is the first step toward reclaiming it. If your current agent, captive or independent, cannot show you at least 3 competitive quotes side by side and explain the coverage differences in plain language, that is information too. The transparency test is simple, and the agents who pass it are almost always the ones worth keeping. At its core, this isn't really about brokers versus agents versus apps. It's about whether you are the customer or the product in the transaction you're engaged in. When the incentive structure is aligned with your outcome, the channel almost doesn't matter. When it isn't, no amount of brand familiarity will protect you. So stay rational, stay curious, run your numbers annually, and never let convenience become the enemy of coverage. The best policy is the one that fits your actual life, not the one that was easiest to click on a Tuesday night when you just wanted to get it done. And if you're ready to take control of your financial picture beyond just insurance, whether that's real estate investing, home contracting, work, or connecting with the right lenders, check out our links in the description below.